Thank you for joining today's webinar on the 2023 Public Pension Investment Landscape, key findings from the BlackRock Peer Risk Study. My name is Hank Kim, and I'm the Executive Director of NCPERS. Today's program is part of our Center for Online Learning, which provides remote continuing education to public pension trustees, staff, and other fiduciaries and stakeholders. In today's webinar, our presenters will preview findings from the latest iteration of the U.S. Public Pension Peer Risk Study. BlackRock undertakes this annual study to provide a holistic overview of the pension investment landscape, including asset allocation, expected returns, risk factor decomposition, and stress testing. Leading us in today's webinar are Andrew Citron, Jonathan Kogan, and Sarah Sawinski. Excuse me. Andrew is a member of BlackRock's America's institutional business. He's responsible for developing and maintaining relationships with institutional investors, including public and private pension plans and pension plans. An interesting fact about Andrew is that he spent 10 years prior to joining BlackRock in the music industry. Jonathan and Sarah are members of the Client Insight Unit within BlackRock's America Institutional Business, where they focus on delivering customized portfolio consulting services to institutional clients. We do encourage audience participation. Please submit your questions by using the Q&A function on this platform. Your questions will be answered near the end of this session. So with that, Jonathan, Andrew, Sarah, the session is yours.
Hank and Lizzie and the NCPERS team, a huge thank you from us at BlackRock, and a thank you to all of the attendees that took time to join us today for what we hope will be an interactive session focusing on what matters most to you for your public pension. My name is Andrew Citron. As Hank described, it's an honor to be a senior member of the pensions team here, based on the West Coast, but in New York City today, as well as the honor of leading our NCPERS partnership on behalf of BlackRock. I'm here, as Hank mentioned, with Jonathan Kogan and with Sarah Sawinski, both of which are from our Client Insight Unit, which really delivers dedicated portfolio solutions, custom insights, including we have deep expertise specific to public pensions, where we will go much deeper today. So today we're going to be sharing details on our industry-leading and recently updated Public Pension Peer Risk Study. So it's going to be in-depth, data-driven approach, including details on the past, present, and prospective future for public pensions, including asset allocation, expected returns, risk factor decomposition, and stress testing. The coverage is vast. We're talking 126 plans encompassed here within the study across sizes, across mid-market to large market to mega market, across the country geographically, as well as across various funded ratio levels. We're using capital markets assumptions, which are BlackRock's 10-year CMAs, updated through May of 2023 this year, and risk return is captured and monitored via our Aladdin platform. So my ask as we go through this session today is really to think from the perspective of your plan, your community, input your questions in the queue, given Hank's instructions, and then certainly don't hesitate to connect with us outside of this forum to go deeper on any of your unique circumstances. So with that, I would like to pass the floor to Jonathan Kogan, my colleague, who can get into some trends on the next slide in the presentation materials. Jonathan, the floor is yours.
Thank you, and really echoing everything that Andrew said. Really appreciate everyone joining, and we're very excited to share some of the highlights from our annual pension study with you all today. So I'll spend a couple minutes laying the foundation, outlining some of the broad trends we're seeing, and then I'll hand it off to Sarah to take us through a deeper look into the fiscal year 2022 results. So if you ask most folks about what is the health of the public pension system, most will point you to the funded ratio. And that's exactly what we're showing on the top section. So it's really illustrating the evolution of the average funded ratio through time. And if you go back to the turn of the century, public pensions were nearly fully funded on average. So that means that their assets could sufficiently cover their future liabilities. And funded ratios have since trended downward, hitting about 85% leading up to the financial crisis, and then hit about the mid to low 70s following that period. And today, the average funded ratio is around 77%, And roughly 60% of plans are now less than 80% funded, whereas just over 1 in 10 plans had a funded ratio below that level in the early 2000s. You'll notice in looking at this chart that some of the funded ratios continue to fall for several years after, really after market drawdowns. And this is really because most plans smooth their asset base over a 5-year period. So I'll point to the 2008 drawdown just as an example. The return experience was still making its impact on funded ratios for several years following the drawdown of the crisis. And then after 2012, 2013, you start seeing that funded ratios really moving range bound for several years after. And you could see this a little bit more clearly on the bottom chart, which really outlines the average year-over-year change in funded ratios. The average of the changes from 2013 to 2020 was just over 10 basis points. But if you look at 2021 and 2022, 2021 really had stellar investment performance across all asset classes. And that's a topic that I'm going to dedicate a little bit more focus to in just a few minutes. But we saw a large needed increase in funded ratios as a result. But it's the market reversals in 2022 which really muted the effects of the strong 2021 performance and potentially the continued upward momentum in funded ratios. So investment returns are really, one of the drivers, not the only driver, because there are a lot of inputs that go into funded ratios. But we're going to cover some of those inputs in a little bit more detail. And I'll transition to slide 6, focus on the first theme, which is really the assumed returns. So the assumed returns have shifted on average from about 8% to 7%. And lowering the assumed return really decreases the investment return target, but even more importantly, it also lowers the discount rate on the liabilities. And this has it's very significant ramifications. So it results in a higher present value of the liabilities and therefore a decline in the funded ratios as well. The top chart shows the percentage of plans that have an assumed return under 7.5%. So the different shades of purple really distinguish the prior year's percentage and the additional percentage of plans joining that cohort in the current year. So if you look at the left-hand side, nearly 94% of plans had an assumed return of 7.5% or higher in 2001. And today, less than 10% have an assumed return at that level, looking all the way at the right-hand side. And the changes in the assumed return were pretty muted until 2010, after which we saw really wide-scale decreases, particularly in the years of 2016, 2017, and 2018. Just focusing your attention on the bottom chart, we show a snapshot of what we show above, but looking at it for the years of 2001, 2010, and 2022 to really illustrate the change in the assumed return distributions over time. So in 2001, over 3/4 of plans had an assumed return of 8% or higher. In 2010, this fell to about 40%. And today, nearly every plan has reduced their return assumption below the 8% mark. In fact, nearly 3/4 of plans have an assumed return of under 7.25, and 1/3 of plans have an assumed return under 7%. So return targets have clearly come down really across the board, but the real question is, how have public pensions performed? And we highlight the reported realized returns on the following slide. So this illustration is really looking at those reported realized returns, and they're looking at all plans that have a June fiscal year reporting date so that we have consistency and good comparison across the universe. And the first theme that we're highlighting here is pretty apparent in the visual, and it's that returns have been fairly volatile. So if you look at that average return, which is that white diamond year to year, you can see that there are some years where we've seen returns as low as -18%, and others we've seen returns 40% higher than that, closer to 28%. But what's even more interesting than just the average return is really the return dispersion between the 25th percentile and the 75th percentile. And you could see that in the length of the orange bar. So the return dispersion in 2015 through 2019 was just over about 150 basis points. But if you look at the last 3 years specifically, dispersion was well over 2x the prior 5 years. So you are seeing that volatility that's flowing through the market flow through the returns of public pensions as well. But the real question is, how do these returns that have been realized, how do they look compared to their target? And the bottom chart really reflects that difference, that gap between the average realized return and the assumed return over the period. And what it really underscores is that the losses hurt more than the benefit of the gains. So if I were to take a very simplistic example, And let's imagine a plan that has a 7% return target, but they achieve a 10% return. It means that the plan beats its return expectation by 3%. But if the plan experiences a 10% loss, it misses its return expectation by 17%. And that asymmetry is clearly portrayed in the 2021 and the 2022 results all the way on the right. But the year-to-year comparisons can only go so far. They are interesting, but what you really need to look at is the impact that they have on a cumulative basis. And just looking at slide 8, that's really a reflection of the findings that we had on the prior slide, but giving a better understanding of the magnitude of the impact over time. And we're looking at this growth of 100. So the dotted line represents the cumulative growth of consistently hitting the assumed return target of 7 to 8%, while the dark line is the cumulative growth of the realized return, really reflecting the market oscillations, the volatility experience of realized public pension returns. So the comparison between the two lines really highlights just how meaningful the drawdowns can become, especially as they compound over time. So if you look at that cumulative return gap on the bottom, that's the difference between the assumed and the realized return. You could see that a significant gap is formed following the financial crisis. And it continues to compound. It continues to compound and widen in the following years. 2021 was a bright spot. The average return was almost 4x the assumed return, and the gap narrowed to a similar level more than 10 years prior. But the headwinds of 2022 widened that gap between the assumed and the realized return to its 2020 level at over 130%. So this really highlights that need for resiliency, flexibility in portfolio construction of pension portfolios. And that naturally brings me to the pension allocations, which we highlight on the following slide. So just looking at slide 9, this is providing a snapshot of the fiscal year 2022 allocation and the year-over-year changes in exposure and risk and return. So the bar charts on the left-hand side really compare the average exposures in 2021 and 2022. The observed allocation changes are more pronounced than what we typically see historically, which might not be as wide of a rate of changes. But here you're really seeing the impact of the denominator effect come through the results. So if you look at the plan changes, you could see plans are now holding 5% less in public equity on average and over 6% more in alternatives. And looking at the detailed exposures, this is really coming through things like private equity, private credit, and real estate as well. And now just focusing your attention on the right-hand side, we analyze the impact of these changes on risk and return. So we use the same exact capital market assumption framework, really to give us a better understanding of how the change in exposure in isolation, not due to market changes, is really driving these metrics. So both the risk and the return increased modestly. Return increased by about 10 basis points. You had risk elevated by about 20 basis points. But if you look at the composition of risk on the bottom, it really changed slightly. But as I'm sure Sarah will highlight in her review of the 2022 allocations, economic growth is still the driving force behind risk. So as we look at this, it's really we sort of think about how can plans change their allocations to potentially find better risk-adjusted returns. And when we think about the higher yields that are offered in the fixed income market today, both in the public and the private market, it may provide an opportunity for plans to really be able to reduce their risk concentration in economic growth and really diversify their factor exposures. And this really ties in with our view that portfolios have to adapt to survive and proactively position themselves for the new regime of higher market volatility, because some of the year-over-year allocations were really likely caused due to the lag of the private market valuations. We wanted to get a better understanding of how impactful this denominator effect is, and really what is a framework for how we can analyze this and quantify it. So looking at the following slide, slide 10, we're really showing what the aftershocks of the denominator effect are. So those are things like, what is the plan's ability to meet its liquidity needs? Those are the things that are really top of mind for investors and trustees as exposures start to shift away from potential target allocations. So as a starting point, we really focus on the fiscal year 2022 allocations from the prior slide, and we apply a market stress in order to better understand this denominator effect. So we shock each factor based on the implications of a 1.5 standard deviation shock to the MSCI world, And we then redeem 2.5% of the asset base to simulate a benefit payment and analyze how those allocations may shift in different valuation frameworks. So we really outline two different frameworks of measurement. The first is the economic lens, and the second is the accounting lens. Now, the economic lens really marks to market all the public and all the private market asset classes. So if you look at private equity, just as an example, it experiences a write-down of almost 40% under this framework. And alternatively, if you look at the accounting lens, this provides a little bit more of an illustration of that misalignment in asset class valuations. So private market assets are shocked by about half the amount of their economic stress or a defined public proxy. So in this framework, private equity experiences a 13% drawdown relative to the US large cap public equities at 26%. So this really results in a meaningful shift in valuations and asset allocation, as you can see on the top section. So what we really want to focus on is more about the differences in the allocation than the actual stress themselves, more than the stress P&L. And that's exactly what the bar charts on the top right are showing. So these are the allocation changes. Between the two frameworks of measurement. And the most pronounced change between the two frameworks is really in the public and the private equity, to no surprise. So as we sort of think about how these exposures are moving out of sync with potential targets, it's really about the proportion of illiquid assets being the primary concern. And that's what we're highlighting on the bottom section. So the line chart on the left is really showing the allocation to illiquid private markets and the delta between the two frameworks that transpires as a result. So as the other asset classes are experiencing more severe drawdowns, the allocation to illiquids becomes a much larger part of the overall portfolio. And this is further reflected in the portfolio's NAV progression on the right-hand side, which shows that the NAV stability when measuring the portfolio using the accounting framework as opposed to the economic framework. The last slide I'll touch on is slide 11. And this is really to line up the rest of the presentation that Sarah is going to take you through. So these are our capital market assumptions as of May 2023, as Andrew outlined. And in the interest of time, I'll really focus on the left-hand side only. So these are your 10-year forward-looking capital market assumptions for select asset classes. These asset class returns are net of fee, beta assumptions, with the exception of alternative asset classes, which we show in purple, because they include an additional alpha adjustment. So we draw a line at 7% in order to signify the median assumed return, really to provide some intuition behind which asset class mix may help plans achieve their assumed return targets. So these asset class assumptions are really the foundation for the rest of the analysis. They're going to be leveraged in the assessment of each plan's risk and return. And I'll have Sarah take you through the fiscal year 2022 results in a little bit more detail.
Great. Thank you so much, Jonathan. Oh, sorry. Andrew, do you have a question?
Very quickly before you start, Sarah and Jonathan, that was great. I just wanted to encourage the attendees, please input questions, given Hank's instructions in the Q&A feature. There are a few questions that have come in outside of that we will address toward the end, but just encourage people to continue to ask questions and we will come back to all of those. But yes, Sarah, please take it away.
Thank you so much. And thank you all for laying that groundwork. So maybe I'll get started on slide 13. So now that we've kind of, as I mentioned, laid that groundwork, over the next few slides, we're going to walk through some of the core content that we include within our peer study that highlights some of those key peer comparisons that we try to draw out in our conversations. So for the next section, we constructed a sample peer group based on different funded ratios, sizes, difference in asset allocation. And if we think about our peer study holistically, really what we're trying to get at is looking at how plans have performed historically, how they're positioned currently, and how we expect them to perform going forward based on our capital market assumptions. So here we start by looking at how plans have performed historically over different time horizons, a 1, 3, 5, and 10-year horizon. And you'll notice with the longer horizon that there's going to be more consistency in the returns across the peer group. But as you look at more recent time horizons, you really do see quite a bit of dispersion. In particular, looking at that 1-year return, if you look at plans F and I, you'll see those two plans really have the lowest 1-year return out of this peer group. And that's really going to be an impact from that denominator effect that Jonathan was mentioning before. You'll see those plans have a bit more of a public market focus, whereas the plans that had a bit of a not as extreme of a drawdown, you'll see those portfolios have a bit more of a private markets focus within their portfolio overall. On the next slide, we compare those longer term returns to the assumed return that Jonathan had started alluding to before for a little bit more of an apples to apples comparison. So just starting on the left-hand side, and just to orient you with the slide, the peer group in question is going to be in purple. And then those gray dots that you see on the rest of the slide is actually going to be all 116 other plans within our peer study. So really wanted to give you that full viewpoint of what the scope of the analysis looks like. So maybe just starting on the left-hand side, looking at that 10-year realized return compared to the assumed return for the peer group as well as the other plans. And then on the right-hand side, we're looking at that 10-year expected return based on our capital market assumptions compared to the assumed return. Over the last 10 years, we found that the average plan in our peer group was really able to easily exceed their assumed return by about 100 bips on average. But going forward, we expect most plans will meet or exceed their assumed return as well, but that margin is going to be quite a bit smaller. And we find that plans with a greater margin for exceeding their assumed return tended to have asset allocations that tilted a bit more towards the alternative side, with the average allocation being for those plans that were expected to easily exceed being about 45%, with about 35% in public equities. So seeing a clear kind of tilt towards that more liquid side of the book. Now, on the next slide, we start pulling in the Aladdin risk side of the story, getting to one of the key questions in our peer study overall of, are you being compensated for the risk that you're taking? So on the left-hand side, we're again pulling in those gray dots, which are going to be all the other plans within our analysis, but also looking at this peer group in particular. On the right-hand side, we also include an efficiency metric, looking at the return divided by risk as a way to kind of gauge where different portfolios fall. And we're not saying that one plan is doing something better than another, because each client is going to have their own unique circumstances and unique constraints. But we do think it's important to understand how their plans might be positioned differently and how you might be able to make tweaks on the margins to improve your portfolio's overall efficiency. And you'll see on the left-hand side, looking at Plan A, we actually highlighted in a bit of a dotted line just to kind of call out some of those differences that we see for this peer group in particular. And there are really some plans that tend to stand out when we're looking at that left-hand side. You do see that there's some clear room for improvement within with Plan A's portfolio to move up into the left. And if we look at some of these peers, getting under the hood and really trying to understand what's Plan D and what are Plan G doing, that might be slightly different than where Plan A is within their portfolio. If we look at Plan D and Plan G, they do have a bit more of a tilt towards alternatives, and they actually have a fairly low public equity allocations, the lowest within this peer group. On the other side of the spectrum, you see Plan F towards the bottom of this slide, and they have really the opposite within their portfolio. The lowest alternatives allocation, really focus in on public equity being the key driver of their portfolio, with over 55% within the asset class. And I would also note that they do have some elevated cash levels as well, close to around 6%. Now, if we flip to the next slide, we actually try to expand a little bit more on what some of those key drivers of portfolio returns are for this peer group. And just to orient you with the slide, on the top half, we try to explain the overall risk and return of Plan A's portfolio in particular. And the size of these circles are going to indicate how large that allocation is within the context of Plan A's portfolio. And so based on these circles, you can really see that they're focusing in on equity exposures within their allocation. You'll see more of a tilt towards both public equity, as well as you'll see the private equity allocation be fairly sizable as well. And these are going to be obviously some higher returning asset classes, but also higher risk as well. This is going to lead again into a bit of foreshadowing. When we look at the expected return, you'll see a bit more of a focus on economic growth. On the bottom half of the slide, we look at each plan's expected return and decompose what portion of the asset allocation is driving that. And so you'll see some of those more efficient plans that we were looking at on the prior slide. So Plan D, Plan G, having a bit more of a diversified pool of assets, driving different asset classes, driving that overall portfolio return for themselves. You'll see Plan F as well. You'll see that really dominated by that public equity exposure, as I had alluded to before.
Sarah, maybe one question, partially
Yep.
for this slide and partially for the slide before, which obviously, we're having anonymous data, but we customize this for clients to show, different plans they may be interested in, different sizes, maybe in their geography. But each plan, as we're thinking here, clearly they have their own perspective on both every asset class, as well as broader aspects like their definition of risk and how they think through that in the right time horizon. So my question is, since the time horizon overall for these plans is long, how important is the risk side? And what is the spectrum that we see on sort of the weighting applied to risk for some of these plans? Because obviously that's going to have a huge impact on slide 15, the return relative to risk. Does that make sense, Sarah?
Yeah, absolutely. And we think that looking at portfolio risk is certainly really vital to the portfolio construction process overall, especially as Jonathan had kind of alluded to before. And looking at those historical returns, drawdown sometimes can hurt even more than the gains. So that's really why I wanted to highlight that and bring up that question on the prior slide of how can you be efficient with the risks that you're taking, especially in this higher volatility environment that we're in. Those small changes in asset allocation really do matter quite a bit. So maybe with that, Andrew, that was a nice transition into the next slide where we start to get under the hood a bit more, looking at those specific asset allocations and how that drives the overall portfolio risk on the right-hand side. So maybe just starting with the top left-hand table, looking at that average allocation for both this peer group as well as that all plans average, which is going to be the average across all 126 plans within our peer study. You'll see the fixed income assets in shades of green, equity in shades of blue, and then the alternatives in shades of purple and pink. And at the highest level, we can see that this peer group is fairly in line with that all plans average, a little bit more of a tilt towards alternatives compared to public equity. But if we look deeper within the peer group, as I had alluded to before, you do see quite a bit of dispersion across the different peers, and there's going to be some outliers at Plan F that we had already talked about that are going to be a bit more alt focused, and some others that are going to be a bit more focused on public markets. Plan A in particular, as we saw with the circles on the prior slide, tends to be a bit more focused in equity exposure, both public and private, being about private equity being about 18% of their total portfolio. Now, drilling into your point, Andrew, before, if we translate these allocations into a risk factor perspective, you can see the risks of all these portfolios on the right-hand side, as explained by macro factors, which are going to be broad drivers of portfolio risk and return. And as you can see on the right-hand side, a key driver of the risk for most plans portfolios, as we've alluded to thus far, is really going to be that economic growth risk factor. On average, we find that it makes up about 75% of the average portfolio's risk. And this is going to be driven from exposure to broad equity market returns. So think your public equity exposure, private equity, but also asset classes like REITs in particular that are going to have a higher correlation with those public equity market movements. And looking at Plan A in particular, we mentioned that focus on equity risk within their book, and you can see that economic growth is going to be a key driver of their portfolio risk on the right-hand side, and going to be a key reason why they have one of the higher risk profiles compared to some peers. Now, thinking back to few slides prior when we were looking at some plans that were slightly more efficient with the risks that they were taking that were up a bit to the left. You can see what's driving those overall positionings a little bit more. So maybe just starting with Plan D, portfolio is really interesting in that one of the most efficient plan within the group for about 300 bips less risk for about 100 bips more return. Looking at their asset allocation, you'll see this, they have the highest allocation on the private side within the alternatives allocation compared to this peer group. And what's interesting is within their, they're really looking to take a bit more of their credit exposure on the private side. And so you'll see their alternatives allocation be a bit split between both public equity and private credit. Now looking at Plan G, that was another plan that I had highlighted before, and we saw less risk for higher return. And looking at how they're positioned, you see a fairly diversified alternatives portfolio. You do still see that focus on private equity, which we tend to see in most public pension portfolios, but you do see a bit more of a tilt towards real assets exposure as well. They actually have the highest allocation to infrastructure within this peer group. And if you look at the right-hand side and you look at their risk factor decomposition, you do see them have one of the higher credit exposures within the peer group as well. So you'll see them getting a little bit more of those of that risk factor diversification. And this really speaks to some of the benefits that you might see of incorporating less correlated assets into like real assets, like credit, into your portfolio that has that economic growth risk, can help boost your portfolio return without adding too much more on the risk side. Now, on the next slide, we apply these same portfolios and portfolio allocations, but look at their estimated profit and loss in various stress scenarios. And one downside to that risk measure that we were looking on the prior slide, which is going to be a value at risk measure, is that it estimates portfolio loss under normal market conditions, and it doesn't quantify potential loss in extreme events or market abnormalities. And we think it's certainly important to prepare your portfolio for downside mitigation. So for illustrative purposes, we wanted to include a few topical, historical, as well as hypothetical scenarios focused on inflation as well as Fed policy implications looking for this peer group. And maybe just starting with the first scenario to orient you with the slide, if you look at Plan A's portfolio allocation and apply a crash of 2008 stress, so the market drop that we saw from the Lehman bankruptcy, Plan A would be expected to lose about 26% of their portfolio value. And looking across the board, you see that there are certainly some plans that, a few plans that stand out. Typically, we'll see portfolio plans that have a higher portfolio risk that we saw in the prior slide. Will tend to see those perform worse in these extreme stress events, such as the crash of 2008 and the COVID drop, where that economic growth factor takes a large drawdown. What's really interesting is looking at Plan F and Plan D's performance actually on the slide. Plan F had, as we saw in prior slides, had one of the lower risk profiles of the peer group with a clear focus on more public market exposure and had the highest cash allocation out of the peer group. You'll see them perform the best out of the peer group in those two historical scenarios. But on the go forward scenarios and the stagflation scenario, you actually see Plan D perform a bit better. It is interesting as you think about as we head into kind of a new market regime and looking at how portfolios are positioned. We certainly think it's really important to, as you're building out portfolios, to be aware of building diversified allocations, especially on the alternative side, and not only to develop portfolios that have better risk-adjusted return potential, but also the potential for increased downside mitigation as well. On the next slide, we try to bring it all together and zoom in on Plan A's positioning, again, relative to both that peer group as well as that all plans average, looking a little bit more clearly under the hood. And as we had mentioned thus far, within their portfolio, maybe starting with fixed income, we saw that it was fairly in line with the peer averages, a little bit more TIPS exposure actually compared to some peers, but in line overall with the peer average in all plans. With about 65% in non-core assets, we find that within fixed income portfolios, there's about the average allocation within our peer study has about 75% of their fixed income portfolio in core exposures. Key overweight within Plan A's portfolio is going to be that focus on more public equity allocation, being a bit above the peer group in the all plans average. And then the key underweight is going to be more on the alternative side and having a bit more of a focus on real estate as well as private equity within their portfolio. That tends to be the kind of core makeup that we tend to see with most portfolios. On the public pension side is going to be that focus on alternatives and on private equity and real estate. Now on the real estate side, and you can see, and we did have a question come in on kind of REITs allocations within public pension portfolios, and you can see those averages here, with the average allocation to REITs being kind of about 1% of that total portfolio. We do tend to see more of that real estate exposure come through on through private real estate, and core making up a key component of that. But of course, each client's situation and liquidity needs are going to be different. That kind of brings me to my next point is at the bottom, you'll also see that we've highlighted Plan A's illiquid allocation compared to those two averages. And you do see a bit of that underweight allocation, again, going to be driven by having a bit more of that alternatives exposure in REITs as opposed to more on the private side. And from our conversations with clients, this really is certainly a question that comes up quite a bit of how much illiquidity can my portfolio withstand to meet my benefit payments and my spending requirements. And we found when we looked at market drawdown simulations that if you have an annual benefit payment of about 5% of AUM, you have room for about 36% allocation to private market assets, and you'll still be within this green conservative zone on the right-hand side, which is the amount that a plan can have in private markets before they start to face any liquidity concerns. And you'll see we've highlighted Plan A's liquid allocation with that white dotted line, as well as their annual net flows. So this is going to be benefit payments less those contributions coming in, and then looking at that as a percent of AUM. And you can see that there certainly is some capacity for Plan A to increase some private market exposure and still stay within this conservative zone. And this is really one scenario that we find most public pensions are in. And to us, this is a key question that that public pensions need to kind of ask themselves is how much illiquidity can I withstand given my benefit payment needs, and how can I best spend that liquidity budget? Now, we've walked through a lot of information today, and on the last slide, we highlight some of these key takeaways from what we've discussed, as well as some areas of focus that we're hearing from clients. And maybe the kind of three key takeaways that we might have for you all is what you see on the bottom half of this slide. It's kind of different areas that we are hearing from clients that we think clients should focus on within their portfolios. And the first is around inflation. We think go forward inflation will remain sticky and stay above 2% target levels for some time. And when we think about plans, particularly those with cost of living adjustments, incorporating inflationary hedges into the portfolio construction process is key. So think about some of those asset classes that I had mentioned before on the real asset side as not only a way to improve portfolio diversification, but also embed that inflation hedge within the book. The second is around diversification. As I had mentioned, and we saw on prior slides, economic growth is going to be a key concentration within most public pension portfolios, making up about 75% of that overall portfolio risk. And so as we're thinking about ways that we can diversify some of those exposures and reduce that concentration, incorporating income-related oriented assets such as public, private credit could be a way to diversify that overall exposure and help and also provide the potential to boost risk-adjusted return for the portfolio. And lastly, is it related to flexibility? As we've seen over the last year, we've seen heightened macro and market volatility. And we really think that this requires strategic allocations to become a bit more tactical, incorporating some flexibility to dial risk up and down within areas of the portfolio. We think that's certainly key to creating durability of that overall portfolio return amidst all this market volatility. So before I turn it back over to you, Andrew, I just wanted to make the comment again that if you all have any questions, we're happy to answer those here or offline. And we're also happy to run this analysis specifically for your portfolio as well. So please feel free to reach out to us. We're happy to put together a customized analysis looking at your portfolio relative to your peers. So thank you all for your time.
Sarah, thank you. That was great. Before throwing it back to Hank, for the Q&A, there's been a number of questions that have come through both today as well as leading up to the session from some of these attendees. So the landscape is ripe today, both with opportunity and risk. So this is a very timely discussion, and we're committed to supporting this community both today as well as what Sarah mentioned, which is sharing this complimentary resource to the extent others have follow-up questions or questions specific to their plans. So Hank, I'll turn it back to you. I think perfect timing. We have timing for at least a few questions.
Absolutely. And let me just add my congratulations and thanks to Sarah, Jonathan, and you, Andrew. It was a fantastic presentation. So going into the Q&A, we just got one. And one is, can you address to what extent exclusion of ESG investing affects return performance?
Yeah, absolutely. So I'll try to tackle that one. And, Sarah and Andrew, please chime in if there's anything that I miss. But our capital market assumptions actually include, so ESG is very hard to quantify, and our BlackRock Investment Institute, which is our internal think tank, has done some research to figure out how to be able to include some aspects of ESG into our capital market assumptions. So some of it they feel like is more of a some of it, because it's hard to quantify, will be more of a implementation component, and that's going to be more of an alpha decision. But there are other aspects of it that they felt like they could actually embed into the beta of the capital market assumptions, particularly around climate and the environmental piece. So our capital market assumptions are actually climate aware, and they do take into account the effects of more green orientation around a return profile, taking into account the effects of climate change.
Sarah, Andrew, did you have anything to add?
Only thing I would add, this is really going deeper on Jonathan's point, but just we think about it a lot on the risk side. And it's the same way we would think about any other investment, which is what are the risks that dictate this particular investment? So, within ESG, some asset classes maybe are more impacted by those risk factors than others. So we always want to be aware of risks across any theme and any asset class in the market, and ESG is no different than that.
Great. And then maybe I should ask before we go any further. So if people who are watching this want to actually get the U.S. Public Pension Peer Risk Study, where can they get it? When would it be available? And is it limited only to BlackRock clients, or is it publicly accessible?
We're happy to share it with any of the partners, Hank, that you and the NCPERS group are working with. So I would say certainly we have some of this publicly available more broadly. We also have this data through NCPERS, or they can reach out to us and we can have a direct discussion. So any of those channels are best depending on their needs and the needs of your partners.
And the one thing the one thing I'd add to that is that when we do this in more of a one-to-one engagement, it's highly customized for that particular client. So the peer group will actually have names on screen, and it will actually have a It'll actually be, the plan cohort will be the choice of the plan that we're presenting to in question. And this is also a subset of the analysis. Sarah, I think what do we hit 70 pages this year in terms of the length of the analysis that we have. So we go into some deeper. We include some deeper analytics into some of the sub-asset classes as well, driving into alternatives, fixed income equities. So we're happy to share that, and we'll also have a paper coming out, which will be hopefully available in the coming month or so.
And I will add, just as a final period on this, that I believe you all are going to be presenting a variation of this at the Public Pension Funding Forum, which will be held August 20th through the 22nd in Chicago, Illinois. So hopefully people can attend that. We have another question that just came in. The third area of focus was to be tactical in dialing up and downside risk. How does this translate to rebalancing or market timing?
Yeah, maybe I'll start off, and then Jonathan, feel free to chime in. But the key aspect of that comment was really around you can kind of approach it from two different lenses. One is going to be from those asset allocation ranges that you might have within your SAA, adding more flexibility within those ranges and those rebalancing ranges. The second is going to be, and that's always going to be a challenging aspect, but looking for managers that might have more flexibility within their mandate. So on the fixed income side in particular, looking at managers for maybe more of an unconstrained type of approach where they have that ability to dial up risk or down, especially given the significant market movements that we've seen within the fixed income sector over the last year.
Great, thank you.
And the one thing I'd add to that is that, for strategic asset allocations, to Sarah's point, we think that they're going to have to be done more frequently because you have the potential in a fast moving market to really miss out on opportunities. And I'll give one example of how, in today's market, the asset allocation can change quite drastically. So there was a bit of research that we were looking at in terms of how much pressure are plans putting on their growth assets to outperform if they have 20 to 25% in fixed income. So when fixed income yields were close to 1%, that meant that you had to sort of hit a return in order to hit a 7% assumed return. You had to hit about a 9% return or higher on your risk assets to really outperform if you had 20 to 25% in fixed income. But now that yields are significantly higher in fixed income, call it 4 to 5% on the short end, you might have the ability to really transition some of that portfolio. So if you were to say, I can still hit 9 to 10%, in my growth asset book, that means that you could actually have something closer to 50% in fixed income, so almost double. Now, we're not conveying that you should have 50% in fixed income, but the point being is that you can really look to diversify what your current portfolio allocation is. It has to be revisited because the market today is much different than the market yesterday.
Right. Another question just came in. I understand that most public fund real estate is held in private investments. What about infrastructure? What do you recommend, private or public? And also, do you recommend infrastructure as a standalone or part of a liquid multi-sector real asset product that includes the ability to tactically allocate across real assets?
Yep. So here I can start out, and then others feel free to jump in. So we would, within the framework of our PERS study, we certainly do where granularity is available. We try to capture whether an allocation is infrastructure or commodities, or what that sub asset class is within real assets. We do typically see most plans within their SAAs will have a real assets bucket, which will incorporate asset classes like real estate, as I had alluded to, but infrastructure as well. On average, we find that the average allocation to real estate across all 126 plans within our peer studies around 2% of the total portfolio. We do tend to see that be a bit more on the private side, but again, we're pulling this and gathering this information from publicly available sources, so that might be a bit more liquid for some scenarios. The key aspect I would say when thinking about either private infrastructure or public infrastructure is really thinking about that and being aware of that correlation to the rest of the asset class. Each client, as I had alluded to before, is going to have their own unique liquidity needs and liquidity constraints within the portfolio. So that's certainly something to be aware of. But if you look to more of the listed infrastructure side, that will have a higher correlation with other with public equity markets. So you might not see as much of that diversification benefit as you might see as going on more the private side, where there's a little bit more idiosyncratic risk built into the asset class.
Jonathan, do you care to add anything? Or
Sarah's on point as usual.
okay. All right, then going to a few of the questions that were submitted ahead of time. Does asset allocation for public funds adjust for being cash flow negative?
Yeah, and that was one of the questions I tried to hit on when I was looking at that liquidity chart overall, because that's where we actually, one of the data points that we've tried to, each year we're trying to improve our peer study overall. And one of the new data points that we've added in this year is looking at that cash flow component and trying to capture that through benefits paid and contributions coming in, and looking at that portion relative to the overall portfolio AUM, and using that as a way to determine how much you can have in the private market assets before facing liquidity concerns.
Then another question has to do with interest rates. Any suggestions on how pensions should view the impact of rising interest rates, which will fall on long-term risks?
Yeah, and I think this is similar to what we outlined. So if you sort of think about a higher yield environment, this could be really beneficial in terms of having an opportunity to really enter the market, to really alter the risk factor concentration that many public pensions have, which is that focus on economic growth. So you might be able to add a certain amount of rate risk. And it's also about where you actually position yourself within the curve. So our house view is that we tend to be more overweight on the short end. We're tactically underweight on the longer end as a result of investors requiring potentially a higher liquidity premium on the longer end. And then in addition to that, just the return that you get relative to the risk you're taking on the short end is significantly improved.
Sarah, you raised this during your presentation, but just to underscore, can you share insights into plans allocation to real estate, especially REITs?
Yeah, so as I had mentioned before too, and I think some of the materials highlight it well on that kind of final summary slide, where we do want to make sure, as I mentioned before, we're capturing these allocations as granularly as we can, because as I mentioned, that REITs exposure is obviously going to have a very different risk and return profile compared to private real estate. And on average, we do find that REITs allocation is about 1% of the total portfolio. And we do see that the traditional kind of real estate exposure tends to be on the core real estate side for most public plans.
Great, thank you. And the last question will be to Andrew. Andrew, I mentioned at the beginning that you do have experience in the music business. So compare working in the financial industry with your past experience in the music business.
I'm happy to. Maybe a longer conversation, somewhat for another day, but for folks on the line that aren't aware, I am a former founder. I formed a record label, later sold it. I had much more hair back then playing rock and roll in those days. I mean, I think the comparison, there's a lot of similarity. I mean, first of all, our business is a creative industry, whether it's how do we work with clients? How do we find ways to generate alpha? How do we partner, internally, externally, with third parties and in communities like with NCPERS. So I think that's point number one. Point number two is there's so many intermediaries. And in music, I would actually say there's more intermediaries. And as someone that was in it in depth, sometimes you questioned whether they even had a role. In our industry, there's so many intermediaries that are important. Custodians, consultants, actuaries, clients, the board members. So it goes on and on. And it's very important, though, to learn What is the process? What are those relationships? Build those. And the last point is probably just use of technology. Something that I was part of in music about over a decade ago was a huge shift towards social media and what we see now. But at BlackRock, we're constantly using technology, whether it's thinking about this peer study or other semblances, to just serve our clients. And that gets to, I think, how can we achieve the outcomes that we want to? Whether you're in a band, whether you're running a pension fund, what are those outcomes? When I started in music, the recipe was everyone wanted to not only be commercially successful, but be in movies with their music, or in video games, but they would sell 10,000 CDs out of the back of their trunk. They would then try to get signed by a label, and they would try to make money later. I think the model has very much flipped to the other end of, okay, you want to be, as an outcome, have your music in a movie or on a TV show. Find ways to do that now. Build those licensing, understand the process. Oftentimes are RFPs. Fun fact, you try to get your music at a commercial, you fill out an RFP. It's the same way as trying to compete for private equity business. So I guess my comparison would be, it's a creative business. Both are, there's so many intermediaries. You have to be technologically advanced and see where the puck is going, and you have to think about outcomes. Hank, thanks for the question.
Yeah,
I'm
you're
very
welcome,
impressed
Andrew.
that I'm so impressed that someone actually read the bios to ask that question. So it really shows the, how in depth all the people on the call are. So very, very impressed.
Well, with that, Sarah, Jonathan, Andrew, again, thank you for this wonderful presentation and the insights that you provide with your study. Thank you to BlackRock for the support and the partnership that you all have been providing to NCPERS and the broader public pension community. And last but not least, to our audience members, thank you for tuning in today. This will be the last webinar that we do for the summer. We're going to take a hiatus in July and August, but we'll be back in September with another very interesting topic for those of you who are tuning in. So everybody have a great summer, and we will see you back on campus in September. Take care, everybody.
Thank you.
Thank you.